Siobhan, over the past year, we've had repeated inflation surprises, both globally and locally, with rates pushing up. What's our inflation outlook from RMB?
That is a very good question. Inflation has risen for the last two prints, so for February and March, with yesterday's print being the second surprise in the wrong direction. We are expecting inflation to moderate. However, there are a couple of shocks that, are continually hitting the system. We know last year it was commodity prices, particularly in the wake of the outbreak of war in Europe, which also affected fuel prices. Now, fuel price inflation is moderating quite nicely, but food prices remain quite stuck, to put it honestly. We saw food actually rise to 14.4%, the highest it has been in a very long time. And this has been driven partly by things like load shedding, which is affecting the cost of production for manufactured food. But, we are also seeing kind of shocks from a weather point of view, with the rand being weaker. It's also affecting the price of things like maize and wheat, which are priced in US dollars. So inflation has been very tricky. We do expect that it is going to start moderating and fall within the inflation target by the end of the year. However, it's not going to be as fast as we originally expected because of stickiness, largely as a result of food prices.
And in that environment, are we now at the peak of interest rates, or are they going to hike again?
We think that we are probably at the peak. And, supporting this is the fact that despite the fact inflation went higher, core inflation, which removes your very volatile items such as food and fuel, actually remains stable at 5.2% in March. Which suggests that some of this, upward pressure from food and fuel is not necessarily translating into second round effects. So there's definitely space for the MPC to pause and to see if the hikes that they have implemented since last year are having an impact on kind of the broader inflation basket. That said, there is definitely a risk for further hikes. And that's going to be dependent on what we see happening to core inflation as the year progresses, as well as inflation expectations. John, turning to you, how would you approach this uncertain environment?
Well, from a corporate perspective, obviously these continued rate rises really get our corporates worried. A lot of them exposed to floating interest rates, or the interest rate bill going up as the repo rate rises. And that generates a lot of interest in hedging that risk away, moving from floating rates to fixed rates. But it's a very tough environment. We're very late in the cycle now to be hiking. And when we do the backtesting work, it shows us that this is not the optimal time late in the cycle. Swap rates themselves are maybe a little bit expensive, certainly relative to where you think the repo is going to go, particularly looking towards rate cuts next year. So our approach with corporates is, yes, we understand you want to hedge. Those who have to hedge, probably better using some of the structured products, caps, cap spreads, things like that. Those who don't have to hedge, maybe doing a little bit now, but rather waiting for a better opportunity for entry.